Welcome to the Daily Insights That Matter. We begin today's DATM by talking about India's merger and acquisitions activity, which has touched an all-time high in 2022. Now, while deal-making abroad came to a halt, India scored its best year for mergers and acquisitions. Now, despite the widespread uncertainty, a fragile global economy, and increased regulatory intervention, the M&A activity is continuing apace with strong flow of private capital, which is driving the economy. Now, according to Refinitiv data, the deal value in India increased by 58% to $148 billion in the 9 months ending September 30th, from $93.5 billion in the same period last year. Now, the deal value in the first 9 months of this calendar year has already surpassed the full year totals of $127.6 billion in 2021 and $132.2 billion in 2018. Now, another record was set with 1,795 deals being completed in the first 9 months, which is up 21% from 1,490 deals during the same period last year. The $60 billion merger of HDFC Bank with its parent Housing Development Finance Corporation Limited, the $7.1 billion merger of L&T Infotech and Mindtree, and the $6.2 billion purchase of Ambuja Cements and ACC by the Adani Group have all contributed to the increased worth of the deals. Now, despite major geopolitical and financial headwinds, global M&A activity in the first half of 2022 has been very resilient. Activity in India has been increasing steadily, and the experts predicted that the country's M&A market would soon reach $200 billion. But that doesn't mean next year will come without challenges on the back of global slowdown. Now, the Indian stocks outperformed most major global markets over the past decade, reinforcing the view that investors globally can't afford to ignore India. The dollar returns of Nifty have significantly outperformed leading global indices, including Germany's DAX, UK's FTSE, Hong Kong's Hang Seng Index, and Shanghai's Composite Index over the past decade. The dollar returns of Nifty refers to the returns of the institutional investors and offshore funds' investments in the Indian equities in dollar terms. In the 10 years ending mid-October this year, Nifty returns stood at 124% against 54.5% for German DAX and 33.8% for China's Shanghai Composite Index. The UK's FTSE and the Hong Kong's Hang Seng generated negative returns of 8.4% and 12.8% respectively. Now, what's important to note is that the Nifty has outperformed its peers despite the Indian currency being the worst performer against the dollar in the 10-year period. The rupee has depreciated 60% against the dollar, while the euro has depreciated 23% and the pound has depreciated 27%. The yuan was pegged at 6 to 7 yuans to the dollar, while the Hong Kong dollar moved in a narrow range of 7.75 to 7.87 Hong Kong dollars during the same period. Now, only the US market has delivered higher returns than the Nifty, but that too is primarily because of the strong dollar. The annualized return of the Nifty index without converting to dollars still exceed the returns given by US. The MSCI India's index annualized gross returns over a 10-year period were 7.39%, while those of the MSCI emerging markets were just 1.42%. MSCI US index saw an annualized return of 11.66% over the last 10 years. Now, at a time when the strong dollar is wreaking havoc globally and driving down investors' returns on assets outside the US, the rupee has held up better than many emerging market currencies because of India's faster economic growth. It's a natural phenomenon that money chases growth, and India happens to be a high growth market. India's economy growing from being the 10th largest to the 5th largest, India's market share in global GDP rising from 2.6% to 3.2%, India's share of exports and trade services rising from 2% to 2.2%, and more importantly, India's foreign direct investment share increasing from 2.1% to 6.7% is all testimony to this very fact. That being said, there are many more quantitative evidences which show that the Indian stocks are outshining major global markets over a sustained period of time, and hence overseas investors cannot afford to ignore India if they want world-beating returns. So what does all of this news mean for you? The M&A activity in India had seen a consistent uptrend with the volume and the value of deals hitting new records, despite major geopolitical and financial headwinds. This will have an indirect positive impact on you. Nifty's dollar returns outperforming leading indices globally is another reason why overseas investors cannot ignore India if they desire world-beating returns. This will also have an indirect positive impact on you. While I say this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.